and we are together for the entire subject as such. And let's begin with today's session. The today's session, so in a way, will be about module 8, chapter number, just a second, 4, that is valuation in intangibles. So valuation of intangibles, copyrights, goodwill, brand, etc. So typically intangibles are an integral part of every organization, and they also have a value, and accordingly it needs to be valued while the business valuation is being done. And how it is to be valued, etc. is what we will be seeing in this session. So as you know, I have been restricting myself to the institute's study material that has been provided for this subject, and the overall theoretical aspects I have tried to concisely summarize it in this presentation, which I will be walking you through for the session. And thereafter I will be taking up the short question and answer and the long question and answers, if at all they are there at the end of the chapter. So while doing your preparations and study, if you want to deep dive more further into the study material, you need to refer back to the study material. The presentation is a concise summarization of the concepts that have been explained in the study material. So elaboration wise, problems, illustrations, examples and solutions wise, you will have to refer to the study material itself, and accordingly you should be viewing this session and a PowerPoint presentation during the session that I am explaining out. So let's begin. It's about valuation of intangibles. So module 8 is all about valuation of assets and liabilities. Each and every asset has its own peculiarities, its own ways and mechanisms and logics and pros and cons and limitations also in terms of how the valuation is to be done, because all assets put together is the valuation and liabilities put together is the valuation of the business as such, and hence therefore each component that contributes to the business has to be factored into while valuing. And therefore this entire module is about specific valuations of specific assets, what sort of methodologies, what sort of approaches have to be adopted. So today's session we will cover the valuation of intangibles, how it is to be done. Let's understand what is meant by intangible assets. Assets, of course, intangible means those assets which are not able to see, feel, touch, etc. So definition wise, intangible assets are long-lived, non-physical assets used in producing goods or services. They provide legal rights or competitive advantage. Value generation, intangibles must deliver measurable economic benefits such as increased turnover or earnings via pricing, volume, delivery, etc. Cost savings, example, operational or marketing efficiency. So it enhances market share or visibility is what value generation is being done by the intangible assets. So intangible assets in a way enhances market share or visibility. They help in cost savings also, bringing in operational and marketing efficiency, and in a way intangible assets help increase the turnover or earnings also via pricing, volume and delivery. So IBVT definition per se is non-physical assets like franchises, trademarks, patents, copyrights, goodwill, etc. And grant rights or privileges and hold value for the owner. So that's the IBVT definition. So Ind AS 38, in Indian Accounting Standard 38, wherein accounting standards are aligned with the IFRS. So Ind AS 38 definition of intangible assets is identifiable non-monetary assets without physical substance. So examples of intangibles are goodwill, brand, patents, copyright, trademarks also. So in a way brands are trademarks, but let me, as per intellectual property laws, trademarks are separate intellectual property, and hence let me separately mention this also. So goodwill, brand, patents, copyrights, trademarks. So customer lists, domain names, contracts, non-compete agreements, mining, broadcasting rights, secret formula. All these are examples of intangible assets. So in a way, they can't be seen, they can't be touched, they can't be felt, they can't be smelled, they can't be held also physically. But still they are integral part of the business and do fetch value or do have inherent value and contribution to the overall organizational performances. And therefore recognition criteria, therefore these intangibles have to be recognized, and for that Ind AS 38 gives certain recognition criteria, and those recognition criteria are future economic benefits must be probable. So if at all a particular value is to be attached to an intangible asset, then one should be able to forecast the future economic benefits must be probable in that particular intangible asset. And secondly, cost must be reliably measurable. So whatever cost that has been associated with that particular intangible asset should be also measurable. So these are the two recognition criteria. One is the future economic benefits must be probable. So probability of future economic benefits. And second is the reliable measurability of the cost of intangible assets. So accounting treatment wise, Ind AS 38 mandates intangible asset if separately acquired, it should be recorded at acquisition cost. If acquired via business combination or government grant, then it should be recorded at fair value. If internally generated, then only development phase expenditure is recorded as an asset. So intangible assets, in a way, identifying fair value of intangible assets, valuation approaches. There are three main approaches used: market approach, income approach and cost approach, even for intangible assets. So market approach is based on market activity and comparable transactions. It is very rare to find such identical asset transactions, and brand valuation may use multiples from similar market transactions. So these are the features of market approach in terms of valuation of identifying fair value of intangibles. In case of income approach, common valuation methods under this approach are relief from royalty method, that's first. So in this method, estimates value based on avoided royalty payments if leased from another party. So what is the, in a way, relief from royalty that would have been required to be paid out if leased out. So alternatively, value reflects potential royalty income if leased out. So if a particular intangible asset is leased out, then what will be the income that it will, or income it will generate as a royalty is what the value that gets attached to this intangible. So that's relief from royalty method. The steps involved is analyze comparable royalty agreements, multiply expected revenues by a benchmark royalty rate, adjust it for taxes and cost, and discount it to the present value. So that's the income approach. The second method which is followed in intangible assets is the multi-period excess earnings method, that is MEEM, MEEM we can call it. This method is used for primary intangible assets, example customer contracts or intellectual property. The value is equal to present value of incremental after tax cash flows attributable to the tangible. It adjusts for attrition, related expenses and contributory assets. The third method is with and without method. With and without method, that is WWM in short called as, compares business value with versus without the intangible assets. So in a way, the business value is to be determined based including the intangible assets and excluding the intangible asset, and the difference will be the value of the intangible assets. That's the with and without method. So comparison of business value with intangible and without intangible. The differential is the value of intangible. Value is equal to present value of the difference in projected cash flows under both scenarios, with and without, and it assumes all factors remains constant. Fourth method is about greenfield method. Now this greenfield method is used for franchisee agreements and licenses. It assumes intangible is the only asset, other assets are newly created, acquired, replacement cost deducted instead of contributory asset charges. And fifth method is the distributor method, wherein it's a slight variation of MEM, used when customer based intangibles are not the most significant, assumes each segment generates profits, and MEM is used for primary intangible, this is used for secondary ones. So this is the distinction between distributor method. So that's the variation of MEM, MEM in short. Then comes the third approach of intangible assets valuation, cost approach. It is based on the principle of substitution. So over here value is equal to cost to replace the service capacity of the intangible assets, typically used for software, technology or workforce, and suitable for non-primary business drivers. But this cost approach should be applied with discretion when market participants won't pay a premium. So these are the features or characteristics of cost approach, which is based on principle of substitution which is followed in valuation of intangible assets as such. Now let's move to the different intangible or specific intangible called copyrights. So what is the definition and what is that right? So copyright is a government granted right to creators, example those who are into creativity field or of creativity, intellect and minds. So copyright is a government granted right to creators like authors, artists, sculptors, etc. for their original works. So because of their creativity, they are creating some original work, and therefore government has granted right to these authors about the original work that they have created. So the duration of this copyright is valid for the life of the creator plus 70 years. So in a way, the life of that particular asset is the life till the life of the creator is, which is like plus 70 years, and it grants exclusive rights to reproduce, publish or sell the work also that has been created by that creator. So that's the logic behind creation of the copyrights. The cost of copyright in such case, if purchased, if the copyright is purchased, then it includes purchase price plus the legal fees. Why legal fees? Because it's about ownership of a particular copyright. There has to be legal ownership of that particular copyright, and therefore there has to be valid legal contract or agreement with the creator that the buyer has to enter into. And therefore there are legal fees that will be attached to it while purchasing a copyright, and hence if purchased, it includes purchase price plus legal fees. If the copyright is self created, then no cost can be capitalized or assigned as such. Amortization methods: one is a straight line method or unit of production method based on the usage or revenue. Fair value calculation will involve, fair value is determined by evaluating future cash flows generated by the copyright. Then second intangible is about goodwill. Now this goodwill is, let's understand definition and concept of goodwill. Goodwill exists, so these are the features. Goodwill exists when a business earns higher profits than comparable business. It represents intangible advantages like reputation, customer loyalty or superior management. Internally generated goodwill is not recognized as an asset in accounting due to lack of identifiability and measurability also. So these are the characteristics of goodwill. Accounting perspective wise, IFRS mandates that goodwill arises only during acquisition. Secondly, it is recognized when purchase consideration is more than fair value of net assets acquired. And formula wise, goodwill is equal to purchase consideration minus fair value of assets acquired. So valuation methods traditionally used for private businesses are super profits methods. Just a second. Give me 2 minutes. So goodwill wise definition, goodwill exists when a business earns higher profits than comparable businesses. It represents intangible advantages like reputation, customer loyalty or superior management. Internally generated, if at all, goodwill is not recognized as an asset in accounting due to lack of identifiability and measurability also. Accounting perspective wise, IFRS mandates that goodwill arises only during acquisition and recognized when purchase consideration is more than fair value of assets, net assets acquired. Therefore, formula wise goodwill is equal to purchase consideration minus fair value of assets acquired, because under IFRS goodwill is only created when it is acquired, when only during acquisition. The valuation methods traditionally used for private businesses are super profits method, average profits method and annuity method for valuing the goodwill. Now let's understand each super profit methods. The key steps are: average capital employed is calculated as revalued closing assets minus current liabilities plus 50% of current year's profit after tax. Adjust for non-operating income, long-term loans and preference shares, etc. Normal profit is calculated based on industry rate of return on average capital employed. Therefore, super profit is equal to actual adjusted profit minus normal profit. The goodwill value is equal to super profit into number of years purchase based on business stability, goodwill nature, etc. Other key points typically that are involved are: goodwill value is often embedded in overall business valuation, not usually valued separately unless required for specific purposes like acquisition or shareholder valuation per se. So that's how super profit methods are calculated. Just a second, let me see whether I have missed anything from the study material per se. No. Theory-wise, nothing has been missed, so I was just a bit confused. Yeah, it's valuation of the brand now. So brands. So typically brands includes definition and role. So brands means what you can say, brand is a marketing related intangible asset. So brand is a marketing related intangible asset including logos, names, terms, trademarks, etc. It helps in identifying products and services amidst a whole lot of products and services that are available in the business environment and building distinct consumer perceptions also. It can include trademarks, formulas is wrong English, it should be formulae. Recipes, design, rights, etc. Strong brands impact business by influencing customers, employees and investors. Brands create economic benefits via recognition, loyalty and perceived value. So brand valuation methods, which are there again, three approaches: market approach, sales comparison approach. So over here compares the brand with similar brands that have been sold or licensed. So some kind of a sales comparison of a brand is considered for market value or market approach. Compares the brand with similar brands that have been sold or licensed. Factors considered over here are the legal protection, brand strength, market conditions and economic environment. It requires detailed comparability analysis also. Second approach is the cost approach. It is based on cost of building, replacing or reproducing the brand. It reflects what a prudent buyer would pay, not more than the replacement cost, not commonly used for final valuation but can be used for validation as such. So this is what the cost approach is. Income approach typically is the values the brand using the present value of future earnings expected over its useful life. It involves analyzing market size, I guess, just a second. Give me 2 minutes for the presentation, just a second. Yeah, now it's better. Now it's visible. So market value, market approach is all about sales comparison approach. Compares the brand with similar brands that have been sold or licensed. And the factors that are considered are the legal protection, brand strength, market conditions and economic environment. requires detailed comparability analysis. Obviously, it's all about sales comparison approach. That's why it needs some comparability analysis. Cost approach is based on cost of building, replacing or reproducing the brand. Reflects what a prudent buyer would pay, not more than the replacement cost. Not commonly used for valuation, final valuation, but can be used for validation. The third approach in brand valuation is the income approach. It values the brand using the present value of future earnings expected over its useful life. It involves analyzing market size and segments, estimating current and future cash flows, determining growth rates, risk, discount rate, useful life and tax impact. So this is how the income approach is in brand valuation. Most commonly used and detailed approach is considered, income approach is considered to be most commonly used and detailed approach as such. Just a second, it's not visible. Yeah, that's better. Moving ahead, so relief from royalty approach assumes the brand is licensed rather than owned. It estimates royalty payments saved by owning the brand. Steps include determining comparable royalty rates, forecasting brand specific revenues, adjusting it for the costs, taxes and risks. And calculating the net present value of saved royalty payments. Then comes the other intangibles basically. So just let me yeah. So that's all about relief from royalty approach. Then comes the other intangible assets. Yeah, so other intangible assets covering different types of intangible assets and their valuation accounting treatment. Let's understand what are the other types of intangibles. Trademarks and trade names. So distinctive word, phrases or symbols, example Coca-Cola, Microsoft. So the cost treatment is similar to copyrights, registered with the patent office for 10 years, renewable indefinitely, and amortization over shorter of useful or legal life not exceeding 40 years. So that's how the valuation is being done for trademarks and trade names. Then comes the leaseholds. So again, there is the issue with this. Yeah. So leasehold wise, basically leaseholds are wherein lessee gains exclusive right to use the property via contract. Leasehold improvements includes enhancements made to leasehold property. Now these leaseholds are governed by Ind AS 116-117, which is about lease accounting standards. The right to use, that is ROU asset, is equal to present value of lease liability, initial direct costs, restoration slash dismantling costs as per Ind AS 37, and prepaid lease payments, that is lease incentives received. So that's how the valuation of leasehold is done. Please pardon me for the So then another kind of intangible, other intangibles are franchisee and lease licenses. So franchisees are contractual rights to use trademarks or products. License is the government grants used to use of public property for services. The cost should be capitalized. Amortization is over shorter of contractual or useful life not exceeding 40 years. Another category of intangible assets are concession agreements. The concession agreements are the government grants use of national property, example ports, radio, spectrum, etc. Initial one-time fee and is capitalized as intangible asset. Initial one-time fee is capitalized as intangible asset, and recurring usage-based payments are treated as revenue expenditure. So that's how valuation is done of concession agreements, which are entered or primarily are government grants. Research and development. So internal use research and development cost is expensed and disclosed. Contract-based research and development is capitalized as inventory. Income recognized via percentage of completion method or completed contract method. Then comes and the typical R&D cost includes salaries, materials, equipment and facility cost, only depreciation if reusable, and intangible assets used in R&D. Then comes another kind of intangible is, that is computer software cost. So if software is to be sold, then cost for design, coding, testing, training materials expensed as R&D. After technological feasibility is established, design for customer needs and capitalized as intangible assets. After product is ready for release, cost become product cost and not R&D cost. So with this the chapter ends in terms of intangible. Sorry about this. So typically these are the copy paste errors that happens, and one has to be really vigilant about it. So in a way we are at the end of the chapter, and now I will be taking you through the short question and answer and long question and answers which are there at the end of the chapter. But before I start with, let me just change the slide title. Yeah. So the various short question and answer typically summary out over here. Just a second. So definition and significance of So short question answer first is about definition and significance of goodwill. Comprehend the definition and significance of goodwill in the context of intangible assets. Also discuss the essentials that come under goodwill. So in that goodwill concept that is being discussed is goodwill is an intangible asset representing the value of a business beyond its identifiable tangible and intangible assets. It includes brand reputation, customer loyalty, high employee morale and proprietary technologies. It increases with the positive market reputation, strong supplier relationships. Yeah. So these are the three essentials that come under goodwill. Goodwill is an intangible asset. Goodwill includes brand reputation, etc., and it increases with the positive market reputation, strong supplier relations, and effective marketing strategies. Then second short question and answer which is discussed is, sorry, I miscalculated all the font size, I guess. Yeah. So second short question answer deals with valuation methods for intangible assets. Discuss various valuation methods for intangible assets considering relief from royalty method, multi-period excess earnings method, and with or without method and their potential applications. So in a way, the relief from royalty method values assets like trademarks by estimating avoided royalty cost. Then second is the multi-period excess earnings method, that is MEM, uses forecasted cash flows attributable to the intangible asset discounted to present value, and with and without method is compares business performance with and without the intangible asset, useful for patents or customer contracts. Then third question and answer is about Ind AS recognition criteria for intangible assets. Create a brief explaining Ind AS requirements when recognizing intangible assets. Focus on the two major criteria set by Ind AS. So under Ind AS, an intangible asset can be recognized only if future economic benefits from the asset are probable and the cost of asset can be measured reliably. If not, then expenditure is expensed when incurred. So that's the way the recognition criteria for intangible assets that has been explained in Ind AS. Fourth question is about comparability. Yeah. So, comparison of valuation approaches, evaluate the critical difference between cost approach, market approach, and income approach when valuing intangible assets. So, over here, cost approach is based on cost to recreate or replace the asset. Market approach compares similar assets in the market, and income approach uses discounted future cash flows. So, cost and market are historical, and income is future oriented. Then fifth short question answer talks about comparison relief from royalty versus meme. So compare the relief from royalty method and multi-period excess earnings methods for the valuation of intangible assets. Which one is more useful in what kind of context? So over here, relief from royalty is best for licensable assets like trademarks, values, avoided royalty payments, and meme are best for assets that are primary income drivers, example patented tech, and wherein it values future excess earnings. Then comes a long question and answer. To long question and answer, number 1 deals with brand valuation using relief from royalty approach. Assuming the brand specific revenue is 60% of total revenue, derive the brand value of logos limited using the relief from royalty approach. The discount rate is 10%. So over here, hint wise, the steps that are involved are: step 1 it shall be calculate 60% of total revenue, which will be brand specific revenue. To that, multiply with royalty rate is equal to annual royalty savings. Step 3 would be discount each year's savings to present value, and step 4 would be sum all discounted values, which will be the actual brand value. Then long question answer 2 deals with goodwill and value of business. Given revalued assets and profits of ST Limited, how would you calculate goodwill and the value of business using the super profit method? So in that, step 1 would be calculate average capital employed. Step 2 would be compute normal profit, that is capital into normal rate. Step 3 would be adjusted net profit to get super profit. Step 4 would be compute goodwill, that is equal to 3 years purchase of super profit. And step 5 would be value of business is equal to total assets minus liabilities plus goodwill. Then comes long question and answer number 3, which is about valuation approaches for brand. So over here, the market approach is, it compares the brand with similar brands sold in the market. Cost approach includes based on the cost to build or replace the brand, and income approach is estimates present value of future earnings attributable to the brand. Then question and answer 4 deals with valuing book copyrights using income approach. How are copyrights of a book valued using the income approach? And hint wise, the step 1 would include forecast revenues, price into units into growth rate. Step 2 would be deduct production / distribution cost, which will be is equal to net cash flow. Step 3 would be discount the net cash flows at appropriate rate, and sum of all discounted values will be the copyright value. Then question number 5 is about concept and recognition of intangible assets under Ind AS. Briefly explain the concept of intangible assets and the criteria to recognize them as per Ind AS. Now this has been answered, or this is to be answered in following way. Intangible assets are identifiable non-monetary assets without physical form like patents, trademark or software. Recognition under Ind AS requires probable future economic benefits and reliable cost measurement. And last long question and answer is about valuation of key income generating intangible asset. How should a highly valuable intangible asset like the secret formula of a soft drink be valued? So using the multi-period excess earnings method, MEM, since the formula is the key driver of a business cash flow, it calculates present value of the incremental earnings attributable to the asset. So that's how, with this we come to an end of the session as well as the chapter, which is about valuation of intangibles. But as a matter of practice, I will quickly walk through and summarize what all we have covered in the session. So we started off with understanding what is meant by intangible assets. The definition of intangible assets are long-lived, non-physical assets used in producing goods and services. They provide legal rights or competitive advantages. The value generation that is being done is intangibles must deliver measurable economic benefits such as increased turnover or earnings via pricing, volume and delivery. Cost savings, example, operational or marketing efficiency, and enhanced market share or visibility. So IGBVT definition wise, non-physical assets like franchises, trademarks, patents, copyrights, goodwill, etc. grant rights, privileges and hold value for the owner. Ind AS 38 definition, identifiable non-monetary assets without physical substance. Examples of intangibles are goodwill, brand, patent, copyrights, trademarks, customer lists, domain names, contracts. Non-compete agreements includes non-compete agreements, mining, broadcasting rights, secret formula. Recognition criteria of Ind AS 38 is future economic benefits must be probable and cost must be reliably measurable. Accounting treatment of intangible assets, if separately acquired, recorded as at acquisition cost, acquired via business combination or government grant, then recorded at fair value. If internally generated, then only development phase expenditure is recorded as an asset. Then intangible assets, identifying fair value of intangible. Valuation approaches are the three main valuation approaches used are market, income and cost approach. So market approach is based on market activity and comparable transactions. Rare to find identical asset transactions. Brand valuation may use multiples from similar market transactions. Income approach, common valuation methods under this approach. One is a relief from royalty method, is what we saw, wherein estimates value based on avoided royalty payments if leased from another party. Alternatively, value reflects potential royalty income if leased out. And the steps involved are analyzing comparable royalty agreements, multiply expected revenues by a benchmark royalty rate, adjust for taxes and cost, and discount it to the present value. Second method is about multi-period excess earnings method, which is MEM. So used for primary intangible assets, example customer contracts or IP. Value, present value of incremental after tax cash flows attributable to the intangible, adjusted for attrition, related expenses and contributory assets. With and without method, that is WWM, it compares business value with versus without the intangible assets. The value is equal to present value of difference in projected cash flows under both scenarios. It assumes all other factors remain constant. Greenfield method is the fourth method, used for franchisee agreements and licenses, assumes intangible is the only asset, other assets are newly created or acquired, and replacement costs deducted instead of contributory asset charges. Fifth is the distributor method. So distributor method includes variation of MEM, used when customer-based intangibles are not the most significant. It assumes each segment generates profits, and MWM is used for the primary intangible. This is used for secondary ones. The third is the cost approach based on the principle of substitution. Over here, value is equal to cost to replace the service capacity of the asset. Typically used for software, technology or workforce, suitable for non-primary and business drivers, should be applied with discretion when market participants won't pay a premium. Then we saw copyrights, the definition and rights. Copyright is a government granted right to creators, authors, artists, sculptors, etc. for their original works. Duration wise, valid for the life of the creator. So almost like plus 70 years. Grants exclusive rights to reproduce, publish and sell the work. Cost of copyright, if purchase, includes purchase price plus legal fees. If self-created, no cost can be capitalized or assigned. Amortization methods are straight line methods or unit of production method based on usage or revenue. Fair value calculation will be fair values determined by evaluating future cash flows generated by the copyright. Goodwill, definition and concept. Goodwill exists when a business earns higher profits than comparable businesses. It represents intangible advantages like reputation, customer loyalty, or superior management. Internally generated goodwill is not recognized as an asset in accounting due to lack of identifiability and measurability. Accounting perspective, IFRS is, as per IFRS, goodwill arises only during acquisition, recognized when purchase consideration, fair value of net assets acquired. Formula, goodwill is equal to purchase consideration minus fair value of assets acquired. Valuation methods traditionally used for private businesses are super profits, average profit methods, and annuity method. In the study material, we have been just considering super profit methods. The key steps involved are average capital employed is calculated as revalued closing assets minus current liabilities plus 50% of current year's profit after tax, adjusted for non-operating income, long-term loans and preference shares, etc. Normal profit is calculated based on industry rate of return on average capital employed. So super profit is equal to actual adjusted profit minus normal profit. Goodwill is equal to super profit into number of years purchased based on business stability, goodwill nature, etc. Other key points are goodwill value is often embedded in overall business valuation, not usually valued separately unless required for specific purposes like acquisition or shareholder valuation. Brands definition and role, we saw brand is a marketing related intangible asset including logos, names, terms, etc. Helps in identifying products, services and building distinct consumer perceptions, can include trademarks, formula, recipes, design rights, etc. Strong brands impact business by influencing customers, employees and investors. Brands create economic benefits via recognition, loyalty and perceived value. Brand valuation methods include market approach, that is sales comparison approach, compares the brand with similar brands that have been sold or licensed. Factors considered: legal protection, brand strength, market conditions and economic environment. Requires detailed comparability analysis. Cost approach, based on cost of building, replacing or reproducing the brand, reflects what a prudent buyer would pay, not more than the replacement cost. Not commonly used for valuation, for final valuation, but can be used for validation. Income approach values the brand using the present value of future earnings expected over its useful life. Involves analyzing market size and segments, estimating current and future cash flows, determining growth rates, risk, discount rate, useful life and tax impact. Most commonly used and detailed approach. Then we saw brands relief from royalty approach, assumes the brand is licensed rather than owned, estimates royalty payments saved by owning the brand. Steps include determining comparable royalty rates, forecasting brand specific revenues, adjusting for costs, taxes and risk, calculating net present value of the saved royalty payments. Then we went through various other intangibles covering different types of intangible assets and their valuation and accounting treatment. To begin with, we saw trademarks and trade names. Trademarks and trade names are typically distinctive words, phrases or symbols. Example, Coca-Cola and Microsoft. Cost treatment is similar to copyrights. Registered with Patent Office for 10 years, renewable indefinitely. Amortization over shorter of useful or legal life not exceeding 40 years. Then other type of intangible that we saw was the leaseholds. Lessee gains exclusive right to use the property via contract. Leasehold improvements, enhancements made to lease property. Government by India by Ind AS 116 and 17 lease accounting standards. Right to use assets is equal to present value of lease liability, initial direct costs, restoration dismantling costs as per Ind AS 37, and prepaid lease payments, that is lease incentives received. Then we saw how valuation of franchise and license is to be done. Franchise is the contractual right to use trademarks and products. License is about government grants use of public property. Government grants use of public property for services. The cost should be capitalized. Amortization over shorter or contractual or useful life. Shorter of contractual or useful life not exceeding 40 years. Concession agreements, government grants use of national property. Example, ports, radios, spectrum, etc. So these concession agreements, initial one-time fee would be capitalized as intangible asset. Recurring usage based payments will be treated as revenue expenditure. So research and development R&D, internal use research and development cost is expensed and disclosed. Contract based research and development capitalized as inventory, income recognized via percentage of completion method or completed contract method. Then R&D cost typically includes salaries, materials, equipment and facility cost, only depreciation if reusable, intangible assets used in R&D. Computer software cost, if software is to be sold, then cost for design, coding, testing, training materials, etc. are expensed as R&D. If after technological feasibility is established, design for customer needs, capitalized as intangible assets. And after product is ready for release, cost becomes product cost, not R&D. Then we went through various short answer summary. In that we saw the definition and significance of goodwill component. So in that, goodwill is an intangible asset representing the value of a business beyond its identifiable tangible and intangible assets. It includes brand reputation, customer loyalty, high employee morale and proprietary technologies. It increases with a positive market reputation and strong supplier relations and effective marketing strategies. Then we saw relief from royalty method, values assets like trademarks by estimating avoided royalty cost. Multi-period excess earnings methods, MWM, uses forecasted cash flows attributable to the intangible asset discounted to present value. With and without method compares business performance with and without the asset useful for patents or customer contracts. Then short question and answer third is about under Ind AS and intangible asset can be recognized only if future economic benefits of the asset are probable and the cost of asset can be measured reliability. If not, expenditure is expensed as when incurred. Then we saw the comparison of valuation approaches. Cost approach is based on cost to recreate or replace the asset. Market approach compares similar assets in the market, and income approach uses discounted future cash flows. So cost and market are historical based and income approach is future oriented. Then we saw in short answer of number 5, relief from royalty comparison with MEWM. So relief from royalty is based for licensable assets like trademarks, values, avoided royalty payments, and MEM is about based for assets like that are primary income drivers, example patented tech, and values future excess earnings. Long answer summary we covered was the brand valuation. So in that the steps that are to be considered are calculate 60% of total revenue which will give brand specific revenue, then multiply by that by royalty rate which will give annual royalty savings, discount each year savings to present value which will that sum of all discounted values will be brand value. Then in question number 2, the steps that are involved are calculate average capital employed, compute normal profit which will be capital into normal rate, adjust net profit to get super profits, compute goodwill is equal to 3 years purchase of super profits, and value of business will be total assets minus liabilities plus the goodwill. Then in long question and answer number 3, the valuation approaches for brands were discussed, and market approach is about comparing the brand with similar brands sold in the market. Cost approach is based on the cost to build or replace the brand. Income approach estimates present value of future earnings attributable to the brand. Fourth is about valuing book copyrights. So in that, step 1 would be forecast the revenues, that is price into units into growth rate. Step 2 would be deduct production and distribution cost which will give net cash flow. Step 3 will be discounting the net cash flows at appropriate rate, and fourth step will be sum all discounted values which will give the copyright value. Long question answer 5 dealt with intangible assets are identifiable non-monetary assets without physical form like patents, trademarks or software, and recognition under Ind AS requires probably future economic benefits and reliable cost measurement. The last long question and answer dealt with valuation of key income generating intangible asset, how it should be valued. So use the multi-period excess earnings method, that is MEEM, since the formula is the key driver of business cash flows. In that it calculates present value of the incremental earnings attributable to the asset. So with that, we come to an end of this session and the chapter also. And so we'll stop here. In a way, we are done with this 4th chapter also, and see you in the next session with the new chapter of module 8, and stay tuned. Bye bye. Thank you. See you.